Hey, John Mayfield for Global Real Estate School, the real estate tech guy, and thank you so much. We are going live on Sunday, July the 7th. I thought this was the 7th. It's kind of been a long weekend, so I'm kind of trying to still figure out what day are we on. So it's Sunday afternoon. I've been covering financing terms, terminology, definitions, kind of going quickly through some of those, but I thought today we would go into my course. So hopefully you are seeing my course here. I'm just going to kind of make sure that we are broadcasting loud and clear. I think so. Let's see here. Yep, looks like we are. So good. All right. So I'm actually logged into the student portal. This is part 4 of financing. And actually, I'm going to jump over here. We're going to jump down. I'm actually in Articulate Storyline, the course creator. So I'm going to jump all the way down here to the flashcards, because in all of my modules or courses at the end, I have some flashcards. So we're going to jump down here to the flashcards. And I just realized that I made one quick mistake because these are all locked, but that's okay. We will drop down here. You'll still be able to see everything. So I'm going to just close a few things out here. You can always do a workaround, right? So no big problem. When you go live, that's what happens. But normally I wanted you to see this because it normally will has a really cool little thing where you can preview and the flashcard flips around for you, but no problem. I just want to go through. I thought it would be better to go through more of an extended session on financing terms. So I'm going to look at purchase money mortgage. We're going to look at all of the financing terms that I have as part of the flashcards in the course. So let's go down to purchase money mortgage. And we actually talked about this specific definition in one of my shorter YouTube videos. Purchase money mortgage is any time the owner participates in financing, or we call this seller financing. So the tip for the real estate exam is that if you see the words purchase money mortgage, you have to connect that to seller financing. Now, the questions I've seen a lot of times or have heard about really are more scenario based, where there's a story and the seller is maybe financing just a portion of the mortgage, not the entire loan balance, just maybe like the down payment or something. And the question wants to know, what kind of mortgage is this, even if the seller is just financing part of the mortgage. And as you can see here, it would be considered a purchase money mortgage. So the owner of the real estate can be another source of real estate financing called seller financing or a purchase money mortgage. Don't forget that. Keep in mind, it doesn't matter if the seller's helping with a small portion of the down payment or the entire loan amount. Anytime you have this type of situation, we call that a purchase money mortgage. Fixed rate loan, I think that's pretty self-explanatory. The rate remains the same for the entire length of the loan. Kind of one of those issues that we wonder about with the real estate market in general, because for most of my life, interest rates were 6-7%, all the way up to 18. They dropped down to 12, 13, hung around there for many years. And then kind of the bulk of my financing career, or my real estate career, I should say, rates have been anywhere from 6, 7 to 10%, 11%. So think about that. Rates got down, 2%. I mean, they were low, very low. There may have been some adjustable rate mortgages for like 1 3/4, or fixed rate loans at 3%, 2.75 happened for a long period of time. A lot of those people who locked in at those lower rates, will they ever want to give up that rate? Because as you can see, a fixed rate loan doesn't change. It stays the same forever. So kind of one of those things we worry about in the real estate mortgage or in the real estate business is, we'd love for some of those people to want to get back in the game and buy and sell, right? So, and it will happen. But fixed rate mortgage, the rate stays the same the entire length of the loan. What about an adjustable rate mortgage? Well, it does just exactly what it tells you it will do. It adjusts up or down, okay? So you can see here a loan that provides the interest rate to go up or down over the course of the loan. Normally, the adjustable rate mortgage is tied to an index, such as the Consumer Price Index or the 11th District Cost of Funds. You won't be asked that on the exam. Don't worry about that. What you need to understand is this. It's an adjustable rate mortgage, so it can go up or down. Years ago, when I first was in the real estate business and interest rates started going up back in 1979, 1980, and so rates started going up. And there were two things happening at that time. There were banks, commercial banks, which we know are still in existence today, and there were a lot of savings and loans who were making loans. Bulk of the real estate residential home loans back then were either made by banks or savings and loans. I'm sure you could get one from a credit union, and there were a few mortgage brokers around in my area, and I'm sure in some of the big cities, but banks and savings and loans pretty much had the market. So let's go back to the 1980s. Interest rates began to go up really high, and commercial banks had this little clause in many of their mortgages and deeds of trust, which basically said, we have the right to raise your interest rate. Actually, they had what was called a demand feature. Many of the banks that I know had demand features. And when we mean demand feature, what happened, and I read many of these letters, the local banks sent letters to homeowners and basically said, dear Mr. Mayfield, we regret to inform you, but your loan is now due and payable on this date at the bank. However, so after your heart stops beating, and hopefully no one had a heart attack and died reading the letter, when you got to the next paragraph, the paragraph basically said, however, if you'd like to come into the bank, we have some new loan documents we'd like for you to sign, and we'll be glad to continue servicing your loan. The new loan documents raised your interest rate, and I saw people whose rates went to 16, 18, 19%. It was a very, very tragic situation. Now, the savings and loans at that same time period, a lot of them did not have those demand clauses in their mortgages and trust deeds. And when I use the word mortgages or trust deeds, remember, some states use a mortgage, two parties, mortgagor, mortgagee, and states that use a trust deed, there are three parties. We have the trustor, trustee, and the beneficiary, okay? Well, in the savings and loan situation, they couldn't raise interest rates. And so they're having to borrow money at 14, 15%. And, they have these loans on the books that are not paying them enough money. And so the savings and loan went into this big whirlwind. And we had this thing that came about in the 1980s to really resurrect and save a lot of the savings and loans. The trust, trying to remember the name of that thing the federal government created. But in essence, through all of that, we became more conscious of adjustable rate mortgages, and there were some government uh, guidelines put in place that said, hey, Mr. Lender, if you're going to issue an adjustable rate mortgage, you can't go raising it 5, 6, 8, 10 points at a time. You're going to have to, number one, tie this adjustable rate mortgage to an index like we're talking about here. That's why I said the consumer price index, or a lot of times you would see the 11th district cost of funds. And so the bank needs to show you all of this in writing, and still even today. And so there's an index that the lender will look at, and they will then they will add a margin to that index, okay? And so the margin might be a certain percent, like 2% or 2.5%. So if the 11th district cost of funds, let's say, is at 11%, and there's a 2.5% margin, then they could raise your interest rate to 13.5%. Okay? The 11th district cost of funds is 11%. You have a 2.5% mortgage or margin. That's 12.5, 12, 13, 13.5. However, if you took this loan at, let's say, 8%, and it was a 2% adjustable rate mortgage, then they can only raise it 2% each adjustment period. So if you were at 8, even though with the margin they could raise it to 13.5, they would have to cut it off at 10% because you have a 2% adjustable rate cap, 5% over the life of the loan. So if you get an 8% adjustable rate mortgage, the highest it could ever go would be 13%, 5% on top of 8%. Now so just want you to understand, there are caps, there's this margin, there's an index, but all of that came out because there were a lot of people whose overnight their interest rates went 6, 7, 8% higher than what they were normally paying. It was a very, very challenging, horrible time period for many people, and many people lost their loans. And so because of that, we have some of these items that are in place for an adjustable rate mortgage. So I'm going to read this again, and I just want you to think about this as we go, now that I've explained all of that to you. So the interest rate can go up or down, and it will be tied to an index. With that index, there may be caps that are 2 or 5%, 2% per adjustment, 5% over the life of the loan. And you can see there the interest rate cannot adjust more up or down more than those numbers. And there's normally what we call a margin. And for some reason, I don't see the margin on there, but the margin is just what they add to the index, so if you're taking notes, okay? Now, people want to say, I don't want an adjustable rate mortgage. I've seen people pay a lot of money in closing costs to get a fixed rate loan. And so one of the nice things about an adjustable rate mortgage is your closing costs are usually not as high as a fixed rate mortgage, because the bank's going to charge you discount points and loan fees, remember? And that's 1%. 1 point equals 1% of the loan amount. Normally, adjustable rate mortgages will be much less than a fixed rate, but it's not tied in for the length of the loan, right? It can go up or down. However, if you are military and you're buying your property and you're thinking, you know what, we may not be here but 2 years, an adjustable rate mortgage would be a great way to go. Or if you know you're going to move, or you think you're going to relocate back home, or you're just buying property for a child who is attending college, why get a fixed rate loan and pay all the additional closing costs when you could get an adjustable rate mortgage, have less closing cost and a lower interest rate, and then sell that if you know you're going to sell in 1 or 2 years. So, by the way, if you have any questions, I do have the chat window open, so you can send me a chat message if you'd like to. But that's an adjustable rate mortgage. Now, a graduated payment loan, interesting. Think of graduated. It just graduates up a little bit each year. So the payments are lower than conventional loan payments during the first few years. So you start out with a lower payment, and then the next year it goes up, the next year it goes up, and so forth. Now, I've got a note here, and I would remember this. You could see negative amortization during the first few years. Why? Because it's a lower payment. It's a graduated payment. We have a graduated lease payment too, and so you're kind of learning two issues here. I actually, when I first opened my office in Farmington, Missouri, I had my office was in Flat River, Missouri, about 10, 12 miles away, and I didn't know how this new real estate branch office was going to do. So I negotiated a graduated lease payment with the owner, to where the first year my lease was lower, and then the next year it graduated up, the third year it graduated up, and the fourth year, and by the end of the lease term, everything was the same, and it kind of equaled out. Now, why would I want to do that? Because I'm a brand new branch office, real estate office, the first year. It's going to take me some time to recruit agents, to get some business up and rolling. And so the lower I could keep my payments the first year, the better. Same way with a graduated payment program. Might be ideal for someone who just graduated from college, or someone who just graduated from medical school, or some type of professional person who is establishing their career, and it may take them a little while to get settled. This might be a good mortgage for them, but keep in mind, negative amortization occurs in the first few years. And you may be saying, well, John, what's negative amortization? Negative amortization is when you are not paying enough money to pay off your loan in the required time. So if you're $300 short, it's a graduated payment. So that first year, every month you're $300 shy of what you should be paying. Well, that just gets added back on top of the loan. It doesn't just go away. So that's why we say there's negative amortization, but can be a good loan, or a graduated lease could be good for someone if you're trying to build a business, or you're trying to get your career off the ground, and you know that you're going to have more money coming in at a later date. I always want to just remind people that anytime you go get a loan, it's kind of like going to an ice cream store. There's all these different flavors, and you just have to get creative and think about those. And here's a good example of a balloon mortgage. It's where you make lower payments than what you should make. Well, let me back that up. I shouldn't say lower payments than what you should make. A balloon payment, also called a partially amortized loan, is where let's just say you want to buy a piece of real estate from me, and I want $200,000 for it. And you say, John, could you finance it for me? And I'm like, well, I could finance it for 3 years, but I really need my money at the end of 3 years. And you say, well, $200,000 amortized over 3 years would be, well, I thought I had my calculator up here. I could tell you, but it'd be a huge mortgage payment, wouldn't it? But what if you said to me, John, what if you amortize it over 30 years at 8% interest, or 10, I'll even pay you 10% higher than the current rate. So would you finance $200,000 over 30 years at 10% interest? And at the end of 3 years, I'll give you all your money. Sure. I'll be happy to do that. So that's what we call a balloon mortgage or a balloon loan. It's actually a balloon payment. And it's the correct definition, as you can see here, is this partially amortized loan, okay? But it's a balloon mortgage, and so you amortize it over 20 years, but at the end of 3 years, you've got to go out and refinance and pay that note off. Growing equity mortgage, it's a fixed rate mortgage, which the monthly payments increase over time, and the interest rate doesn't change. There's never any negative amortization, but you're actually paying off the loan a little bit quicker. So it's just growing equity mortgage. Shared appreciation mortgage, I don't think you'll see that on the test. That came out of the 1980s. So don't worry about that. But the lender just shares in the appreciation of the mortgage. Would have been a great mortgage for lenders to have done about 5 years ago because prices have really shot up. But when you go to sell, you got to give part of that appreciation and what it appreciated. So, if you bought it at $100,000 and the lender gets 20% of the appreciated value, and in 5 years it goes up to $200,000, well, you got to give the lender a chunk of money there at the end. So I don't think you'll see that on the test. We talked about reverse annuity mortgage on one of the shorter videos. Really designed for seniors. I've had a lot of people tell me they've been seeing this question on the exam. What is the loan that's correct for seniors? It's kind of funny because I had somebody write me and say, I had a question on the test about reverse annuity mortgage and we didn't cover that in class. Well, I had to go find the slide number, but I'm like, yes, we cover that in class. And this is just, these are just flashcards I wanted to show you. But again, with a reverse annuity mortgage, I'm a senior, maybe my home's paid off or I owe just a little bit of money on it, but the value is up here. And remember yesterday I talked about equity. So if my home's worth $500,000 and I only owe $50,000 on it, I have $450,000 in equity. You take the value of the property and you subtract whatever your obligations are, and the difference between that's equity. That's been an exam question. I'm almost certain you'll see that. Make sure you know what equity is. But this question has been on the exam too. And so if I have $450,000 equity in my home, then the lender will send me payments each month. The question people have been telling me that they're seeing refers to what type of loan would a senior couple or someone in their 60s get. Probably it's a reverse annuity mortgage. Straight loan, pardon me, I got one of these when I was a junior in college. I was selling real estate, semi-commuting to Cape Girardeau. I wanted to go into broadcasting and film, and interest rates went very high. Of course, I got my real estate license when I was 18 in 1978. So it's 1980. I come back home, help my mom out. I always wanted to get my college degree, so I shifted majors to become a business major and switched from Warrensburg, Missouri to Cape Girardeau, Missouri, which was much closer. Had a great schedule where I worked Tuesday. I went down Monday nights and had a Monday night class and finished on Thursday. So I sold real estate Friday, Saturday, Sunday, and Monday. And then I went back to school and did very well selling real estate. And a friend of mine had a 1979 L82 blue Corvette, and I wanted to buy that so bad. And he offered it to me at a great price. And I'm going to college. I didn't want, a big payment, but I wanted a Corvette. So I went to the bank and I said, I told my banker friend my dilemma, and a great guy, Rollo Gordon, man, he was the best. And that was back in the day when banks were so good to work with. And Mr. Gordon said, John, we'll just give you the money you need to buy the Corvette. You pay the interest on it. And whenever you want to pay it off, just pay it off. So a straight loan, interest only is all I had to pay. And then I could make principal payments as I sold as I had homes closed, and you pay off the lump sum at the end of that term, or you renew it. And Mr. Gordon was very good to work with for me. And that's how I bought my 1979 L82 blue Corvette and drove that as a senior in college. So, again, I'm not telling you that to brag. I'm telling you to say, banks will work with you. They will get creative. Sometimes we just have to tell them what our situation is and how they can help us. Not all banks will work with you like that, but you got to try and see. And all they can say is no, right? Or yes, in which case Mr. Gordon did, and it all worked out. They got their interest and got their money, and everything was fine. That's a straight mortgage, and you may see that on the test. Now, don't be fooled by the exam question. I'm going to go back up there to a straight loan, interest only, with a lump sum due at the end of the loan term. They love this question and it's a big, lengthy question where a borrower took out a straight note for $20,000, paid all these interest payments. They give you the interest rate. Interest is due quarterly. I mean, it just goes on and on and on. And then they say, how much is due at the end of the term? Well, it's a straight note, right? Interest only. So the amount due at the end of the term, if the question says they have not paid any toward the principal, they still owe this original loan amount, $20,000, I think is what I used in this example. So that question is seen a lot, and a lot of people get tripped up on that, the way they word it. They want to make you think that they want to make you go in and calculate and try to figure out, well, maybe that interest comes off the loan. No, it's a straight note. So if you take a $50,000 straight note out and you pay interest for 2 years, how much is due at the end of 2 years? $50,000, unless there were some principal payments paid. Private mortgage insurance, talked about this some as we talked about FHA and VA. Private mortgage insurance is used whenever the borrower puts less than 20% down on a home loan. So if you're getting an 85% loan-to-value ratio or a 95% loan-to-value ratio or a 90% loan-to-value ratio, you're probably going to have to take out private mortgage insurance, okay? It's insurance that insures the lender in case you default. And so FHA loans, private mortgage insurance is required. VA loans, there is no private mortgage insurance required because the VA charges that funding fee. Be sure and go watch that video that I did on that. Participation financing, just exactly what it says. The lender's participating in the financing, so they're going to want the profits and share with the losses. Package mortgage, just think in terms of a package with a bow on it, and it normally includes real and personal property. So you just package everything up into one loan. Should be easy to work to answer. Wraparound mortgage, I don't think you will see. That's just where they wrapped around a lower interest. Opened-end mortgage you could see on the exam. We also call this a future advance, future advance funds, or a future advance deed of trust is another name for it. But you're just borrowing the equity out of your property. So many lenders will have a open-end mortgage or a future advance deed of trust, which means if you originally took out $100,000 and you've paid your loan down to $50,000, you have $50,000 worth of equity. Remember, that'll be a test question. Well, if you have an open-end mortgage, you can borrow that $50,000 at any time. However, the new $50,000 will have the current interest rate and the current terms that they provide at that time. Your deed of trust or mortgage will explain that. But it's really a pretty cool mortgage, and a future advance deed of trust seems like there was, but it's a home equity line. It's basically what it is. It's a great mortgage. And if you have one of those, if your central air goes out or your furnace goes out, you can always go and use that equity. If you have an open end mortgage, uses the owner's equity. And don't forget, the new amount you borrow will be at the new loan amount. Buy downs, a lot of builders will do this to buy down a loan. We're seeing that a lot right now because interest rates, have been so low, and now they're still low compared to what I've seen throughout my career. However, in many buyers' eyes, they think interest rates are off the charts, right? So if you can get your seller or a developer to buy down your interest rate, that will make the property more attractive when you go to market it. Now, right now we're in a shortage of inventory, so there's not the need to do a lot of that. However, I've seen a lot of developers offer to buy down the mortgage. Now, you might say, well, John, how do they buy the mortgage down? Remember, a discount point is prepaid interest. So one discount point is 1% of the loan amount. So you could actually pay, or the developer or the homeowner could say, look, I'll be willing to pay 4 points if that will help get the borrower a lower interest rate. And so that's what buying down the loan refers to. Assumption of mortgage, anytime the borrower assumes the property. And we talk about installment sale, which is also called a vendor sale, or we also call that a contract for deed. It's what I refer to it a lot as. It's a land contract. Now, with the contract for deed, installment sale, I want to say a vendor's contract, but I think I think it's contract for deed or land contracts, how you'll probably see that. You could see it as an installment sale. With this type of loan, the seller retains legal title. So I did a contract for deed on a property that I own. If you go to the courthouse on that property, you will see my wife's name and my name on that property. The property's paid off. We don't owe anything on it. And so we have sold it to some folks on a contract for deed. Every month they make a payment to us. And so legally, we're the legal owners, or we have legal title. They just have the buyers have what is called an equitable right, or a right to get legal title when they've made the last payment. Now, the cool thing about a contract for deed is the buyers, have to pay the taxes each year, have to pay the insurance, have to make any repairs on the property, plumbing leaks, roof, whatever, and they still have to make us the payment. And if they don't make the payments, we can take the property back and have them evicted and resell the property. We do not want to do that whatsoever. They're great folks, and they pay like clockwork, and we appreciate that. And so we were helping them out, and that's called a contract for deed, or an installment contract, land contract. Now, what I need you to understand for the test is that the seller, in my case, my wife and I, we have the legal holder, the legal title to the property. Our name's still listed at the courthouse. The buyers have an equitable right. Okay, once they've made all the payments, then they can then we have to give them the deed to the property. Now, the other thing you need to know for these is they're going to use a lot of crazy verbiage in these questions. So you have to remember mortgagor, borrower, mortgagee is lending, right? Vendor is a seller. Vendi is buying. Okay, you got to remember all of that kind of stuff. So it gets a little confusing. That's why the digital flashcards at Global Real Estate School are so important, because you can just download them right to your mobile phone and you can study those wherever you go. Okay, so don't forget that. But you'll probably see this on the exam. Construction loan, I covered that in one of our short videos. Generally used to finance a new home. You get a takeout loan or an end loan at the end. Go watch that video. I cover some really good topics on that. It's just short-term or interim financing, and you're paying interest on whatever the unpaid loan balance is. Remember to get lien waivers when you provide money to the contractor, because mechanics liens can be filed by anyone who provided service or work up to 6 months afterwards. Blanket loan covers more than one parcel of property. So sometimes you might have a blanket loan and you just kind of encumber. Remember that word. See why you need those flashcards? It encumbers more than one property. So sometimes developers have a blanket loan over the whole subdivision, and when they sell one of their properties, they have to get what is called a partial deed of release. So the lender releases that specific legal description that you're selling. Okay, that's why we have to have legal description. So the lien, the deed of trust or the mortgage, that lien encumbers or is over more than one parcel. And if you want to sell one of those pieces, then you need to get what is called a deed of release or a partial deed of release. Sale leaseback. This question's been seen on the test a lot, but the grantor is, there's some question I have in there, but that's why you need to know those definitions. Definitions are so important. Don't get hung up on the math. Know the definitions. Very, very important. But a sale leaseback provides a seller to convey his or her property to a purchaser and at the same time lease it back. So you might have a business that you're starting and you've got this location and you really need some funds to grow your business. So you sell your property to an investor so you can get your funds to go out and do what you need to do. And at the same time, you don't want to leave your location. And so you're just going to lease it back from that person. I'll talk about this more. Certificate of reasonable value is just that's what VA puts as the appraised price on a property. So whenever you get a VA loan, they will put what's called a CRV or certificate of reasonable value, or the market value for the property that's under appraisal. And I have a note here that if there's ever a difference between the CRV, the certificate of reasonable value, the appraisal for a these are on VA loans only, and the sales price, and the veteran has one or two choices. They could have the seller lower the sales price to the new appraised value, whatever that is, certificate of reasonable value, or the veteran could pay the difference in cash. We talked about discount rates. A discount rate, one discount point is equal to 1% of the loan amount. I'm going to have you say that one more time for me. One discount point is equal to 1% of the loan amount, not the sales price. They will try to get you to use the sales price, but don't do that, because John told you a discount point is 1% of the loan amount. Okay? Discount points, prepaid interest, increases the lender's yield on the loan. An origination fee is normally same thing, 1% of the loan amount, but an origination fee covers the paperwork. Well, I have lots of definitions in our flashcards that you can check out at Global Real Estate School. I'm going to jump over here to my screen, and think I can go to that and you can see me here. So, hey, thank you so much for joining me today on this live stream. Wanted to just go through all the financing definitions. I have some amazing, cool things that I have thought about to bring to my YouTube channel that coincide with both Pearson VUE and PSI, and we're going to be starting that real soon. So if you have not subscribed, you need to do that because there's going to be some really cool things that I have coming for you. But each and every day I'm trying to do something short, sweet. Maybe on a Sunday I'll do a live version like this with my t-shirt on because, hey, it's Sunday, and you know what? I need to live stream more, so I don't have to have a fancy shirt on and all of that stuff, right? We're just going to have a good time, and I'm going to help you pass the exam. Be sure and check us out at globalrealestateschool.com. We'd love to have you as a student. Would love for you to subscribe. We have a podcast. It's very, I think, a very great channel. And subscribe to this. I'm going to be throwing in things from time to time from top agents that will help you grow your career. So even after you pass the exam, this might be a good place to hang out. And if you're a real estate agent, hey, the more you know, the more you can talk about real estate and help people with their needs, the more people will put their trust and faith in you that'll help you with your real estate career. So, well, enjoy your afternoon or morning or whenever you're watching this, and have a great day. Check us out again, globalrealestateschool.com. And again, thanks for watching. Have a good day. Bye.